July 18th, 1984, less than 2 years after their first attempt to limit life insurance as a retirement powerhouse vehicle, the IRS took a second swing at it. Here it is. In 1979, universal life insurance was born. E.F. Hutton asked, why don't we have the least amount of insurance for a certain amount of premium and let that grow with the benefits that come with insurance, such as tax-free growth? The IRS didn't like this. They said, what are you doing? They went to court. E.F. Hutton won. IRS still didn't like this. They went to Congress. They passed TEFRA of 1982 to define what an insurance contract is and limit some of this madness that was going on. Well, they might have passed that a little quick, or at least knowing they would need to make some revisions. Then came DEFRA, otherwise known as the Deficit Reduction Act of 1984, passed as Public Law 98-369. TEFRA was a 384-page document. DEFRA, 717 pages. Now, one of the main things that surfaced during TEFRA was the guideline single premium, the guideline level premium, what's considered gross income when I die or it passes on tax-free or take loans. With DEFRA, however, one of the main things, or at least what it's most famous for, is 7702. Now, I have a whole video kind of going into the nuances of that, but essentially what it does in its title is life insurance contract defined. So what it does is not only simply define a life insurance contract, but tells you what you need to comply with if, for example, you're going to use this as a retirement vehicle, to make sure it's still considered a retirement vehicle or an insurance contract as opposed to an investment or a modified endowment contract, which at that point you may be subject to taxes. Well, here's the thing. People were looking at this and saying, okay, I get that now we have to have a minimum amount of insurance, for example, for whatever amount I put in, but I'm still going to have the tax-free benefits. I can access my money tax-free, it'll transfer tax-free, and I still have the market-like returns. People look at the cost per insurance then. Okay, well, my cost per 1,000 is going up as I age, but I'm actually getting less and less insurance as I age because my cash value is growing. Therefore, insurance is, in some sense, getting cheaper as I get older. Yeah, I'm going to put my money there because it's essentially netting a 1% fee over the life of a policy. That sounds good. That's what they were doing. The banks realized this as well. That's what they were doing, even though you'll see in the next video, it came to threaten them. But it's what they were doing with the money that they were borrowing from you. They continue to do this and still do today, except there's one key tax citation in 1988 that many think stopped or greatly reduced the likelihood that the banks would go under. That's TAMRA of 1988, the Technical and Miscellaneous Revenue Act. I'm gonna go over that in the next video, its citations and all of its details. Stay tuned, we will see you there.